Welcome back. This is Dr. Rao. Let's take a look at another exercise in which, again, we have purchased stocks of another company. As a long-term investment at the beginning of 2024 fiscal year, Florus International, we are the investor, purchased 30% of Nursery Supplies Inc.'s 8 million shares for $56 million. So Nursery Supplies has a total of 8 million shares. We purchased 30% of that. We paid $56 million. The fair value and book value of the shares were the same at that time, which basically means I don't need to worry about the goodwill that was implicit over there. During the year, Nursery Supplies earned net income of $40 million and distributed cash dividends of $1.25 per share. That is, to each of their 8 million shareholders, they gave $1.25 in dividends. At the end of the year, the fair value of the shares is $52 million. That's my investment is down to $52 million. So let's see how we would do the journal entries for each of this piece of information. Let's start with the very first one. I made an investment, I purchased, which means I paid cash. Now, it's a 30% investment. Let's stop and think about this for a second. Is this significant influence? The answer is yes. If it's below 20%, it's not significant influence. We just look at the fair value of the stocks at the end of the year. When we get dividends, we'll record it. Otherwise, we don't do anything else. If you have between 20 and 50%, that's called significant influence, and we have to use the equity method, which is what we'll do over here. So this 30% number is important that we see this over here because we'll need to use it in our calculation. And it also tells us we need to use the equity method. So now in the heading, you have that information, but if you look over here, they tell you prepare the appropriate journal entries, which means they expect you to know which method to use. So with that said, let's start out by saying how our journal entry is going to look, what our journal entry is going to look like. Starts out with investment in equity affiliate. You could say investment in Nursery Supplies Inc. or investment in equity affiliate. When we see the word equity affiliate, it means I have significant influence between 21 and 50% of the stocks of the company. I paid cash for that. And the cash I parted with is $56 million. What did I get for that? I purchased 30% of the 8 million shares that are outstanding. So 30% of 8 million shares is what I have purchased. December 31st, Nursery Supplies say they earned $40 million. They earned $40 million. Net income becomes a part of retained earnings. Retained earnings is a part of equity. That's of Nursery Supply. Nursery Supplies equity went up by $40 million, which means my investment went up as well, but not by $40 million. I have 30% of that. So I will debit my investment account to indicate it's gone up in value. And I will credit investment revenue for that same number. Again, what are we looking at? We are looking at 30% of the $40 million in net income that they earn. Not the full $40 million. We have 30%. So that's $12 million. Well, they turned around and gave shares to they gave dividends to all the shareholders, $1.25, which means I got the money too. So I got cash. Let me debit cash. What should I credit? Well, let's think about it. When that company paid out dividends, dividends is paid out of retained earnings. Retained earnings is a part of equity. If they paid dividends, they paid it out of retained earnings, which means retained earnings decreased, which means their equity decreased. So what should I do? Investment in equity affiliates is going to go down in value because they have paid out some of that equity. They paid out. They gave dividends from retained earnings. How much did I get? Let's see what my proportionate share is. They gave $1.25 to 8 million shareholders. I own 30% of those stocks. So that's how much I'm getting in cash. That's $3 billion. Finally, they say at the end of the year, the fair value of the shares is $52 million. December 31st, fair value is $52 million. I paid $56 million, fair value is $52 million. Stop and think, which method are we using? We are using the equity method. So I will ignore the fair market value at the end of the year. So at this point of time, I'm going to say no entry for year-end fair value adjustments unless this downward slide is not temporary, which means I have an impairment. In that case, I have to take a loss. But unless they mention that this loss is not going to be recovered, I don't have to do any journal entry in the equity method. If I had less than 20% of the shares, I do the fair value method. At the end of the year, I adjust up or down to see what the value of the stocks are. But in the equity method, I ignore year-end market value unless they tell me this downward slide is permanent. So with that, we'll move on to our next exercise, which will be another equity exercise.